Hello, welcome to the session. In this session, we will solve the ninth problem from the analysis of statements, and we will be working on this problem of Radlock Company. We have been given the cash flow statement and also the income statement. From this, we are asked to analyze and find out 1. The cash flow statement as per the direct method. 2. Compare the trends for the cash collections from customers, cash payment to the suppliers, cash payments for expenses, and any other element that we think is important. And examine the trends in the income, CFO, and free cash flow. Now, putting ourselves in the shoes of the credit manager of a bank, what is that we will take away from this problem that we will be doing? The problem that has been given to us is the income statement of Radlock Company. The information that has been given to us is for 3 years. The comparative income statement tells us that the net income of the net sales of this company has been $2,127 billion in the year 92, $2,414 billion in 93, and $2,748 billion in the year 94. While this seems to be a very good number, where I see that the growth is found from the year 92 to 94. I want you people to calculate the percentage of growth from 92, 93, and 94 for the sales. And then we see that the net income, in fact, if at all I see that the sales are growing, so I also expect that the profit should also grow. So let me see at the net income. The net income is $34 billion in the year 92. 93 shows as $33 billion, and the year 94 shows that the net income is $44 billion. While I see that there's a dip of net income in the year 1993, if I further investigate, I would rather get into the earning before taxes and extraordinary items. The earning before taxes and extraordinary items are 62 billion in the year 92, 67 in 93, and 71 in 94. Yes, here the top line is growing, and so also the EBT is also, earning before taxes is also growing, that is before the extraordinary items. While I see that the profit after tax of the net income has actually shown a dip in the year 93 because of these two items, which is the extraordinary loss and then the cumulative effect of accounting changes. The cumulative effect of accounting changes. This is one part when I look at the income statement. Let me go into the statement of cash flows that has been given to us. Again, the comparative cash flow has been given for the year 92, 93, and 94. They have actually taken this net income 34,450 and they started adjusting it from the net income. And what does this mean? This means that they have prepared a cash flow statement as per the indirect method. What happens in the indirect method is that all the non-cash expenses are added back to the net earnings, and if there is any change in the working capital, that is also adjusted. The decrease in the working capital, is added back. It is added back because it generates cash, and any increase in the working capital is subtracted. Now let us take, for example, here merchandise inventories 28401 has been subtracted. In the case of that is $28 billion of merchandise inventory, it is subtracted. Now what did they do? As earlier, in the earlier problem that we did, we have been given the comparative balance sheets. And when we have been given the comparative balance sheets, we found out the differences and then we made the adjustments. But in this case, I find that when I look at the bottom, I do not find the comparative balance sheets. I don't have the balance sheet. So what they have done is that these numbers have been culled out from the balance sheet, and whatever differences are there, they have directly adjusted over here. Now, if at all the inventory has been subtracted, it means there was an increase in the inventory, that is increase in the working capital. In the indirect method, if at all there is a decrease in the working capital, we need to add back, because when you add back, you have added it because it was actually generating cash. And this will be only in the case of your expenses. When you are doing the direct method, go by exactly the opposite rule. So that means that if at all it is decrease in the working capital, you should subtract in the direct method, and if at all there is increase in the working capital, you should add back in the direct method. Exactly the opposite of what we do. And then you find that the cash from investing activities and the cash from financing activities have been given. One noticeable difference that I find when we have been doing a problem is again the interest expense. As I said that whenever there is this net earnings, you actually adjust for all the non-cash expenses. At the same time, we also adjust for all the non-operating expenses. When I look at this, the non-operating expenses have to be added back. Say, if at all you're talking about the non-cash and the non-operating, see, the non-cash is the depreciation and the amortization, and the non-operating is the cumulative effect of the accounting changes. They have been adjusted. Why? You see that interest has been adjusted. You see that interest has been taken here. It has been charged in the business for the year 92, 93 and 94 from 39 billions, anywhere from 39 billions to 34 billions. While this has not been adjusted here because we consider that as a non-operating expense. While the author has not brought this non-operating expense of interest into this part. He has not adjusted it. He has not added it back. That means that this person has considered, the author has considered interest expenses as part of operating expenses. Now, as per the FASB standards 95, the interest paid is part of the operating activities. These standards were issued in the year 1987, but there have been amendments later on because we see that this is for the year 92, 93 and 94. You can say that they have been using the old standards, one, and second thing is that US GAAP actually allows this interest as part of operating expenses. The other way I look at it is that because this is these people may have followed the US GAAP and they have actually allowed interest as operating expenses. But as per our Ind AS or IFRS that we are going by, the interest payments are part of financing activities. The interest payments are part of financing activities. So we will make adjustments for the interest as well. So what I understand from this given problem is that we have not been given a balance sheet. We have not been given information about any other assets and the long-term liabilities, and we will have to work on the given under the given conditions. So we have done a little of working here so that it becomes easy for you to understand. So here I have done this working for you. Now, if at all you see that I have actually collected this information from the question that has been given to me here, and I have picked up the information of preparing the cash flow statement as per the direct method. To do it, I will start with the sales of the organization that has been given to me to calculate what is the collections that I have received. So I have taken this information, the sales from the year 92, 93, 94 and put it across here. That's what it is. And then I have made the changes to the receivables. I find what is the cash collections that has been received by the organization. Similarly to the next part is to see what are the payments that have been done. So pick up the COGS. So as I have said that from the cost of goods sold, I have made the adjustment to the inventory and also the accounts payable. The basic rule is that the rudimentary way of doing it is simply change the signs. In the case of inventory it was subtracted here. I have added in this case, and the case of bills payable, it was actually plus, so I have subtracted. So it is exactly the opposite of what has been done in the indirect method. Now this means that when there is a generation of cash, it has reduced your costs. That's the logic over here. So here I have made the adjustment to the cost of goods sold, and I get the what is the amount that has been paid to the suppliers, and then the same in the case of the general and administrative, that is sales, general and administrative expenses. Now here you find that the prepaid expenses, accrued liabilities, change in the other assets, and the accrued wages and the payments of the selling and the general administration is also found out. So you find what is the basic logic I have applied is that whatever is the change in this, whatever is the sign over there, I have exactly changed the sign and made a accumulation of it. The same in the case of interest expenses. What is the amount of the interest that I have paid, and the tax expenses also. You will find that I have applied the same logic of what I have said. Just change the signs from the indirect method to find out what is the value of the direct method. So I have picked up all this information from here. If at all we look at the working, I have taken the cash collections from the customers, 2,119 billion dollars. Then you find that the payments being made to the merchandise is $1,502 billion. Then payment to the selling and the general administration is $463 billion, and the tax paid is $112 billion. All this information has been calculated here. Well, if at all you are looking at this number, cash from operating activities, go back to your text, and then they have given you the cash from operating activities is 100,140. That is $100 billion, $98 billion, and $30 billion. But that has not been the case here. We have taken it as $138 billion in this case. Instead of $100 billion, we have taken $138 billion. The reason we have taken this amount here, we have changed this amount here, is that we have adjusted the interest expenses. The interest expenses, $138 billion to this $138 billion. How did we get it? To this $100 billion, I have added back the interest, which is $39 billion here, and also the adjustment that we have done to the amortization of the issuance cost. So what is the adjustment that I have done? I have done an adjustment of $37 billion to this $100 billion. Where I have made a adjustment of $37 billion. I find that my operating profit is $138 billion. Similarly, I have made the adjustment of this interest of $33 billion to the profit that was given to us by this author here, $98 billion. I made the adjustment, and I find that my operating activity earning is $132 billion.